Is BYD, Tesla's biggest EV rival, really as unstoppable as people think? Let's dig into what's really happening behind the scenes. Hey everyone, it's Ken here. Today, we're diving into the latest developments with BYD, the Chinese EV giant often called Tesla's biggest competitor. There's been some major shakeups recently, and if you're a Tesla investor or fan, you're going to want to pay close attention. You've probably noticed that Tesla has been going through a tough stretch lately. The stock's been under pressure, and global EV competition is heating up fast. So, naturally, the question becomes who's winning right now? For many people, the answer is BYD. And to be fair, BYD has been crushing it in terms of vehicle sales. They've got low prices, a wide lineup, and they're expanding well beyond China into Europe and beyond. But here's the twist, something big is shifting inside BYD. Their free cash flow has suddenly turned deep red, and with new regulations from the Chinese government, their financial model is getting squeezed. In short, the very growth engine that powered BYD might be starting to sputter. So, in today's video, I'll break down what's really going on with BYD from a Tesla investor's perspective. Stick around to the end, and you'll walk away with a much clearer view of where the EV industry is headed and what it all means for Tesla. Let's get right into it. Tesla versus BYD. Different models, different risks. First, let's frame the big picture. Tesla is a US-based EV pioneer driven by full-stack tech, FSD, energy, AI, robotics. It's more than just a car company. BYD, on the other hand, is a Chinese hybrid EV PHEV powerhouse. They also make batteries, smartphone parts, even rail transit systems. In 2023, they briefly overtook Tesla in global EV sales. In China, BYD dominates. Tons of models, low prices, their products are built for mass adoption. Some even claim BYD is beating Tesla. But here's the truth, high sales don't always mean long-term stability. Tesla runs lean, fewer models, higher margins, strong free cash flow, and operational discipline, especially through 2024. But in 2025, BYD's financial picture began to shift in a big way. What's going wrong at BYD? Three key issues. 1. The price. War backfired. In May 2025, BYD slashed prices on 22 models in China, up to 34% off in some cases. Yes, sales bumped up short term, but margins took a hit. By May 26th, BYD's stock dropped nearly 9% in one day. It's the same dilemma Tesla faces, price versus profit, and BYD is feeling the squeeze too. 2. The end of pay later financing. Chinese automakers like BYD used to delay payments to suppliers, sometimes over 200 days, to preserve cash. But in June 2025, China enforced a new rule. All payments must be made within 60 days. BYD confirmed compliance, which means no more financial cushion from delayed payments. This change hits their entire cash flow model hard. 3. A shocking cash burn. In 2024, BYD posted over 365.6 billion Chinese yuan, 50 billion US dollars in free cash flow. But in Q1 2025 alone, they burned through 284 billion Chinese yuan, CNY, say 44 billion USD in just 3 months. Inventory buildup, price cuts, increased investment, and upfront cash payments all played a role. Their operational cash flow is still solid, but the cash out is now outpacing the cash in. Put it all together, and what do we get? BYD is selling a lot, but they're bleeding profit to do it. What this means for the EV industry. Chinese EV makers scaled fast thanks to a triple weapon: massive government subsidies, ultra-low pricing, delayed supplier payments. They lowered prices using subsidies, delayed payouts to suppliers, and used that breathing room to grow fast. But now, subsidies are being reduced. Supplier payment rules are tightening. Overseas markets like Europe are slapping tariffs on Chinese EVs, so the old growth at all costs playbook is breaking down. Even giants like BYD are seeing the limits. And while there are many innovative Chinese EV firms rising, the era of price wins all seems to be fading. What this means for Tesla investors? Yes, Tesla has challenges: demand cycles, delays, fierce competition, no doubt about it. But BYD, they may be leading in volume, but they're losing in profitability, free cash flow, and financial flexibility. Tesla still has multiple growth levers: FSD, robotaxi, Optimus, AI, energy, charging infrastructure, the list goes on. BYD, in contrast, has leaned on sales and scale, but that model is now under serious stress. So, for us Tesla investors, it's important to take a relative view. Tesla isn't the only one facing headwinds. BYD is too, just in a different way, and that's worth remembering when markets get nervous. Quick recap. Today, we explored what's going on inside BYD from three angles. 1. Aggressive price cuts hurting margins. 2. Chinese government tightening cash flow practices. 3. A steep fall in free cash flow, over 284 billion Chinese yuan gone in Q1 2025. These aren't just BYD's problems, they reflect deeper pressure across China's entire EV sector. So while Tesla has its own mountains to climb, its competitors are also under strain, often more than people realize. If you found this video helpful, please give it a thumbs up. It really helps. I post Tesla updates almost daily, so make sure to subscribe if you want to stay ahead. I also share Tesla news and insights on X, formerly Twitter, and Instagram, so feel free to follow me there too. I'm always happy to connect with Tesla fans around the world. And if you're ever planning a trip to Japan, don't hesitate to leave a comment. I'd be happy to help answer your questions. Thanks for watching. Let's keep enjoying this amazing Tesla journey together. Catch you in the next video.